Well, we just had really bad news from the Federal Reserve in 3 different ways. It's not good, specifically for a certain subsector of the market, and it doesn't matter for another subsector of the market. We're going to talk about all of that in this video, but I have to say the things I heard here were not great. First, I have to start with the greatest disappointment. For the last over 2 years, probably closer to 3 years, I've been talking about this subject called fate. It was a 2019 proposal that went into effect in 2020. It was the Federal Reserve's 4-year game plan on how to try to essentially have an average of 2% inflation. It's called flexible average inflation targeting. Well, I feel like a knife was thrown through my back today because apparently fate has nothing to do with actually having flexible average inflation targeting, because when Jerome Powell was asked about it in Congress, he said, well, we made that because inflation was low. It was a way to anchor inflation expectations at 2% and keep them from sliding down. The pandemic may have changed that in a significant way, and we will review this framework at the end of the year, and it'll take about a year to review. So in other words, let me translate that to English. When we said we wanted to target inflation at 2% with a flexible mindset, we only said that because inflation was too low. Now that inflation is too high, we don't care about fate anymore. It was just a manipulation. It was just a rigging to keep people thinking we cared about 2% inflation. Well, I feel like a knife just went through my frickin' back, okay? I'm a little pissed. The Fed tells you one thing and then does the opposite. You suck. You suck. And why does it really suck? Because I thought as we would get to maybe 2.5 to 2 3/4% inflation, the Fed would say, you know what? This is good. We had low inflation for the decade before the pandemic. We have 2.5% afterwards. Guess what? We don't have to change the inflation target to 2.5% because of genie out of the bottle. Fate. Flexible average inflation targeting. It's here to make it all okay. And we'll cut rates, even though inflation's not at 2% yet, because of fate. Well, by rug pulling us on fake fate, and admitting that it was just a lie, the Federal Reserve just blatantly told us it is going to take even longer for rates to go down. If that's not obvious yet what that means, that doesn't necessarily mean we're not going to get our 2 or 3 rate cuts this year. It just means actually getting back to the normalized rates that support interest rate sensitive stocks. It's going to take way longer because there's no fate coming to save you. Maybe that was the fate all along. What an irony. The second thing that was a disaster that we heard was Jerome Powell was asked about Scott Reckler's white paper, which was previewed in Fortune magazine, calling for, quote, 500 or more bank failures coming with a doom loop ahead of us of pain and a, quote, slow-moving train wreck as waves of commercial real estate loans mature over the next few years in an industry that is incapable of solving for that commercial real estate problem. This commercial real estate problem is the equivalent of the residential housing problem we saw in the 2008 recession. Okay, Jerome Powell was asked about that. Jerome Powell's response was, well, we think the commercial real estate sector is manageable. Everything's manageable here. We'll be fine. Well, at the same time as everything is fine, what happened with everything is fine New York Community Bank? Well, New York Community Bank decided to come out while it was trading for about $3.14 and decided to say, hey, we are out of money and our bank is failing. So we're going to raise some money on the stock market. And the stock market's like, oh, hell nah, you are. Stock down 42%. Probably honestly halted for the rest of the day at this point. So very inconvenient timing for Jay Powell's testimony. But a reality that we face that we now have 2 big oopsie doopsies for when it comes to the Federal Reserve. Number 1, fate is a lie. And number 2, the banking system is sound and resilient except for some. Okay, number trace. Okay, third one. Jerome Powell. First one we had here, we had Fate, we had New York Community Bank was the next one. Oh, yeah. And then, of course, throughout most of the testimony here, we got a lot of commentary about, frankly, the Federal Reserve being asked about Basel III, banking regulation. We're not really going to talk much about that because I don't think that matters to normal Americans. What matters to normal Americans is what's going to happen with inflation, interest rates, and, quite frankly, the reality of the direction of our economy. And the Atlanta Fed gave us an update this morning. Rather than GDP continuing to trend down under the weight of interest rates, GDP estimates have once again been revised up. For Q1 2024, we're now sitting at 2.5%, up from the 2.1% where we were about a week ago, down from the 3% from where we were ahead for the prior portions of this quarter. And what that signals, in conjunction with higher CPI reads for January, although those might be one-timers, higher job gains from the ADP report this morning for job changers, which is the first time we've seen an increase since August of 2021, the high jobs report that we had in January, and the JOLTS data today coming in roughly at expectations, showing really we're not having a layoff recession. We're not seeing unemployment meaningfully rise. We're not seeing unemployment claims meaningfully rise. And GDP continues to boom, whether it's because of fiscal spending, debt, or AI. The reality is rate cuts are probably going to get punted. Now, Jerome Powell did suggest that the December summary of economic projections looks for 3 rate cuts coming in 2024. The problem is, he makes it very clear that those projections are old and that they'll be updated on March 20th. Keep in mind, March 20th is the next Fed FOMC meeting date. It's also the date that my daughter will have her reattachment surgery, which is scary. But anyway, we'll be covering the Fed live, then I'll be going to the hospital. So that's on March 20th. Mark your calendar for that. Mark your calendar as well for August 8th when the househack warrants expire, June 30th when the househack fundraise expires. Learn more at househack.com/2024. And of course, June 21st to 23rd for the Meet Kevin Millionaire Symposium, where we're announcing a new speaker this Friday, and we've got a whole lot of inspiration for finance, real estate, and building your wealth over the long run. Super excited to see you there. Check it all out at meetkevin.com. But what does this actually mean? Well, if we look at the Fed rate monitor and we start adding together what we're actually looking at rate cuts, we know the market is already starting to unprice rate cuts. Last year, we were sitting at an expectation that markets and the Fed were going to align with 7 rate cuts in 2024. At this point in time, we are sitting at, let's add that together here quickly. We are sitting at a 46% chance that we are going to get 3 rate cuts. We are sitting at a 4 rate cut percentage of, let's see here, if I add this together, 4 rate cuts, we're sitting at 54%. So we're somewhere right there at a coin toss as to whether we're going to get 3 or 4. I think, unfortunately, there's a risk the Fed might actually kick the can down the road a little bit more. And why do I say that? Well, because of the problem number 3 with the Fed. Yesterday, Raphael Bostic suggested there is a chance the Federal Reserve will not start cutting until Q3, and then after they start cutting in Q3, which could be July, could be the July 31st meeting. Right now, there's a 10% chance we have 0 cuts by July, and then there's a 49% chance we have our first cut in July. Well, after the first rate cut in July, we might actually end up pausing at some point within Q3, holding rates higher for longer. So these are things that we're really starting to hear loud and clear here from the Federal Reserve. And again, does that affect interest rate sensitive stocks? Absolutely. It keeps the boot on the back. Does that affect AI stocks? Not at all. If anything, some argue higher interest rates give companies like Microsoft, Amazon, Apple, and Google more cash flow thanks to the amount of cash they have on their balance sheet, and they basically get to buy AI chips with free money from the interest that they're earning on all the cash that they have. In other words, they're so rich, they could just keep spending on rich people chips. Crazy. Anyway, Jerome Powell obviously reiterates his goal of, getting to 2% inflation, that they'll come out with a plan for Basel III, whatever, Basel III, whatever you want to call it. He does call housing services or suggest that housing services might be elevated in inflation because, well, quite frankly, we use lagging measures of evaluating housing services inflation. But there's also the risk that people just don't move and you don't actually realize lower or new market rents, which is a downside that could potentially keep those housing services levels of inflation higher for longer. Of course, the Fed is aware of that, and I think they try to price that in. He suggests overall we're on a good path in terms of the economy, that it does not look like we are facing a recession in the short term. You do have Jerome Powell suggesting we need just a bit more evidence. So that's bullish, right? That's somewhat bullish. He does say we want some more confidence. We want the 12-month data to be good, not just the 6-month data. Regarding FedNow, he says there's been slow adoption. And regarding the AI productivity boom, he says it's hard to tell what AI is going to do, if it's going to replace workers or augment workers. But the reality is right now, it looks like productivity and the economy are probably trending up, which does actually give the Federal Reserve more latitude to not cut as soon. So, on a bullish side, look, Jerome Powell suggests we just need a bit more to start with rate cuts. On a bearish side, I kind of think you've got a Fed here that's starting to imply that they might unprice 3 rate cuts. I think there's a chance they might revise their summary of economic projections for March 20th to show 2 rate cuts rather than 3. Now we'll see. We have one more data set to go here, a big one. Well, we've actually got jobs on Friday, and then we've got CPI coming up. So once these data sets come up, I think we'll have a little bit more insight into which way March is going to go. But March is going to be a signaling meeting. I do not expect rate cuts in March. Neither does the market. We're looking at just a 4% chance of rate cuts in March. So in other words, no rate cuts in March. We would have heard about it today otherwise. March 12th is the CPI release day. And other than that, I have to say, the economy's doing well. So you can't be mad at the economy booming unless, of course, you're praying for interest rates to fall quickly, which ironically would require a recession, which would hurt the rest of the economy. So that is what we got out of JPow for being live 3 hours and putting together a 10-minute summary. Feel free to drop a like. Check out meetkevin.com for not just the courses on building your wealth, but also the Millionaire Symposium. I'm convinced you won't regret it. My goal is to make it the best YouTube finance and wealth building event of the year, and it'll be in Vegas, June 21st to June 23rd. Thanks so much for watching, and we'll see you in the next one. Goodbye.